market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says he's called off strikes on Iran scheduled for later today after Gulf allies asked for more time to seek a diplomatic breakthrough. Now, Trump says the U.S. remains prepared to attack if an acceptable deal is not reached, but did not give a deadline. Now, the Iran war, of course, continues to drive inflationary pressure and market volatility. Global investment bank Moelis has also been a key player in the region with a history of advising Gulf transactions, including the Aramco IPO. Now, beyond the Middle East, Moelis is expanding in Europe against a wider industry backdrop of consolidation by boutique banks. Well, I'm delighted to be joined by Navid Mahmoodzadegan, the company's co-founder, stepping into the chief executive role in October, replacing Ken Moelis. And he joins us now. Navid, so great to speak to you.
Thanks so much Thanks for having
being
me
with us here in London. Look, there's a lot going on in the Middle East. What does that mean for deal making in general? Are people nervous? Are they holding back? Or do you expect it to pick up?
Well, so we have about 50 people in the Middle East, and I'm really happy to say they're doing well and safe and sound given all the turmoil over the last few months. And what we're starting to see is really a return to normal, if you can believe that. Even though not all of the conflict has been resolved yet, life in the Middle East, life with our deal makers is getting back to normal. They're doing meetings, they're traveling, and there's a real resilience in that part of the world to try to get back to normalcy as quickly as possible. So I'm optimistic about deal making in the region.
So what are your clients saying in terms of the impact of the war?
Well, I think there's a real opportunity when we get on the other side of this to have a new Middle East and to have these incredible countries that are doing incredible development and building great companies. I think there's an amazing opportunity for the importance of that region and the countries in that region to be enhanced. We, as I said, have a major presence there, and we're big believers in the future of the Middle East.
Yeah, I mean, you have especially a big presence in Saudi Arabia.
Yeah.
When you look at the sectors, is it oil and gas, or is it other places?
Oil and gas, it's infrastructure, it's telecommunications, it's travel, hospitality, and leisure. It's many sectors that there's a lot of investment happening, and we're pleased to be there to advise companies and governments in the region.
Navid, I mean, I guess there's always a problem of timeline, right? Because we don't know what happens if there's a resolution, if it's a diplomatic resolution. Like, how do you live through the next couple of months? Well,
look, we're committed. As I said, the safety of our people is our first priority. We are committed to the region long term. We've been there for many years. We will be there for many more years to come. And we're going to continue to add senior talent and continue to serve our clients in the region. We're bullish on the importance of that part of the world, and there's a real opportunity if the war is successfully brought to a conclusion for that region to flourish in a major way.
Do you think it's had an impact on deal making in general?
In the short run, for sure, and clearly geopolitical conflict, rising oil prices, some of those things aren't helpful in the near term to deal making. Despite that, when you look at the overall, deal flows, especially on larger deals, both in the United States and in Europe, the numbers are actually pretty good this year, all things considered. Better than you would have expected if I told you there was a war in the Middle East.
That's true. Why do you think that is? Is it just a resilient economy or chief executive? There's been so many shocks, tariffs, it's COVID, that they've just gotten used to it a little bit more.
I think it's a few things. I think first, if you look at earnings growth and the numbers that the companies are putting out, it's still quite good. And there's still optimism about the economies in all over the world, essentially. And second, we're on the cusp of major technological change with AI and the build out of infrastructure around AI. And companies feel that they absolutely cannot sit out the opportunity to scale their businesses on a global basis. And so I think all of those factors, have helped deal making, especially, again, with the larger deals.
So Moelis is also moving to a larger office in Marylebone. Yeah. How do you plan to continue investing in Europe?
We have about 200 people in Europe, and you're right. We moved to new space over the last couple of weeks in Marylebone. I think it's a testament to our presence in the region. We're going to continue to invest and hire people here. We see great opportunity in Europe. Europe is a very important part of our global network and our global client base, and we're very, very optimistic and love our team here and looking to expand further.
Any specific sectors? Again, it does feel, being European, that sometimes Europe is just trying to play catch up, either with technology giants or AI or even energy and infrastructure.
I think most activity right now is happening in financial services, in defense, in infrastructure, in consumer. I think that's where you're likely to see a lot of elevated deal making here over the next, period of time. And I think those are some of the areas we're looking at continue to invest.
I mean, there's again a lot of question marks politically here in the UK. What happens with the Prime Minister? It can be in France and other countries as well that are going through elections in the next 18 months. Yeah. Does that weigh on chief executives' minds?
Sure. Look, political turmoil and change usually is not a confidence builder. But look, we have political turmoil in the United States too, and some of these forces that require M&A, again, technological change and innovation, the large amount of backlog of portfolio companies that are sitting in the hands of private equity that need to turn over. Some of these major structural forces require M&A to happen, and so we're, once we get through some of the geopolitical noise, once hopefully oil prices come down, interest rates subside, I think that could lead to a really great environment for enhanced deal making.
I mean, I was going to ask you if you thought that inflation, would lead to higher interest rates, and therefore that some of these deals had to be accelerated. Not the good type of M&A deals, but the ones that look a little bit desperate.
Yeah, look, generally higher interest rates is not a positive for deal making, and so our hope again is that we'll get resolution, and rates can come down, and some of the supply shocks we've seen on the energy side, which are creating some of these inflationary fears, subside. I think if that happens, again, when we came into the year, it looked like a banner year for deal making, maybe one of the all-time great years in terms of the environment. We've had a little bit of a setback. I think once we get through this, and hopefully we get through this in a positive way, I think we could be off to the races again.
So just delayed, no
just
fundamental
delayed. I
changes.
think that's our hope. That's our hope. Again, there's risks, but that's our hope.
Navid, talk to me a little bit about your industry. So there's been a lot of M&A amongst boutique banks recently. Yeah. Perella Weinberg, for example, buying Glucher Shacklock, Robin Warshaw. Then what do you make of this consolidation?
Yeah. Well, look, we're in the business of serving as many clients as we can. So our own philosophy on growth has been internal talent development and hiring great world-class bankers from the outside. There is a third strategy, which is also to buy other boutiques. Right after the global financial crisis, there were many boutiques that were formed, including our firm. And some of those firms, 20 years later, are potentially looking to exit, and we're looking at some of those opportunities as well. So, okay. But for the most part, our strategy is really revolved around internal talent development and hiring bankers as opposed to buying firms.
But if you were to buy a firm, is it a specific kind of firm? I don't know what you're doing, for example, private capital advisory.
Yeah, we're building our own private capital advisory franchise, and we're very excited about that. Look, whenever you look at a business like that, the question is, are the people additive to what you're doing? And is it additive to our culture? And can we do a deal that makes sense for both sides? If we found an opportunity that was additive to the culture, that would enhance our capabilities, and where we could do a deal that made sense for both sides, we would certainly look at it.
So would this be a regional play to get into somewhere else, or would it be more of
Could be regional, could be product capability, could be sector capability, could be any one of those three or a combination of those.
What makes a success of an M&A deal? Because you touch on culture, and this has been one of the most difficult things throughout decades, actually, in financial services.
I think that's one of the most underestimated parts of this, especially in a people-based business. We're in a people-based business, and so at the end of the day, what are we buying? If we were to do a transaction, we'd be buying a group of people. And what makes sense, the most important thing is, will those people thrive at our firm inside of our culture? I think we have a very distinct and unique and collaborative culture, and if we could bring on people through an M&A transaction where we would improve their capabilities, they would bring something to us in terms of a product or sector or client skill set, and we could work together in a collaborative way to grow our respective enterprises, that would make the most sense.
How will AI change your business? Or change
It's already starting to. Yeah, it's already starting to. So we're actively evaluating and deploying AI tools for our bankers. I think AI has the opportunity, a really incredible opportunity to enhance our business, to make bankers and all of our employees much more productive. Look, we're in the business of giving advice to clients and doing smart transactions with our clients, and AI can help us do that at an advanced pace. and could help our bankers be more productive. And there's a set of tasks that our bankers sometimes do that can be automated, that could help their quality of life and could help us with our clients.
Does it change the culture of investment banking?
I don't think so. Look, we're on the precipice of a real sea change here. My hope is that it will improve morale and happiness in our industry for our bankers, again, lead to more productivity, and most importantly, enable us to provide even better advice to our clients.
How important are to be involved in large deals? I mean, it feels like it's in an era of, the large deal of like 10 billion plus is really what works. I mean, is your strategy to try and get some of those deals, and how do you go about it?
Yeah, you're right to point out the sweet spot of the market right now is 5 and 10 and up billion-dollar transactions, both in the United States and over here in Europe. Absolutely, we work on lots of large deals. It's very much part of our strategy, and those deals are important to demonstrate our client capabilities and our skill sets.
Is it different getting a big deal compared to a medium-sized deal? Do you pitch differently? Is it, do you have to know the founder from the start? I don't know what the magic sauce is.
Look, big cap coverage and big deals are really about long-term relationships. To earn the right to work on a very, very large transactions, you have to be there giving very good quality advice for a long period of time. You have to be integrated with the management teams. You have to be known by the boards. And, to have the ability to win and work on those kinds of transactions, you have to have a long-term perspective.
Now, so you've been, you co-founded Moelis, but you've been in the top job for a little less than a year. What have you learned? What surprised you the most?
There's nothing that really surprised me. As you point out, I've been with the company since the beginning, and this has been more of an evolutionary change. But look, I could not be more excited about the quality of our people and our talent, the direction of our business. Yes, we're, as an industry right now, going through a geopolitical crisis and rapid technological change, but those are the things that excite me. Those are the dialogues we love to have with our clients, and I've never been more excited about the trajectory of the company and the quality of our people.
Navid, thank you so much for joining us. That was, of course, the Chief Executive of Moelis, Navid Mahmoodzadegan. Now, coming up, the EU taps Swedish investment firm EQT for its latest move in the AI race. We'll speak to Franzén, the Chief Executive, next. And this is Bloomberg. Well, the conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, EQT has secured the mandate to run a new €5 billion EU fund investing in quantum computing, AI, and other deep tech companies. Now, it comes as companies and countries across the world are really racing to fund the AI build-out. Google and Blackstone only today announced plans to create an AI cloud business with data centers using Google's homegrown AI chips. Well, Franzén is the chief executive of EQT, which manages around €269 billion in assets. Thank you so much for joining us. First of all, congratulations on the mandate. Exactly how much will it work? So now you have to fundraise, and will you be putting any of your own EQT capital?
We're very happy and excited about being given the opportunity and the responsibility to manage this fund for the European Commission. The initial fund size target is €5 billion. A substantial amount of that capital will be coming from anchor investors, the European Commission, but also from our own balance sheet. I think the timing couldn't be better for this initiative. The world is moving fast. AI technology is advancing rapidly, and the growth rates that we're seeing are really unprecedented also in AI and other areas where the fund will be focusing.
So, first of all, why is Europe struggling to hold on to homegrown champions?
What we've seen when we looked at the numbers is that over the last 50 years or so, there's been approximately 250 startups in the US that have reached a market cap of $10 billion or more. But in Europe, there's actually only been 14 of those. EQT, the firm that I'm representing, we're one of those firms. So today we're still listed here in Europe, in Stockholm, and we have a market cap of approximately €40 billion, right? But The point is Europe needs more success stories like EQT. And so what we're doing with this initiative is giving startups, promising entrepreneurs access to the scale-up capital required to also reach their full potentials and become global champions.
So, I mean, I guess this is a problem, right? It's a capital problem. I mean, often it's a money problem. I don't know at what stage some of these European companies need that money to become European champions instead of moving to the US.
Exactly. So what this analysis shows is that Europe doesn't have a startup problem, it has a scale-up problem. And that is what this initiative is addressing.
So when you look at, the European tech ecosystem, where do you see that system needing money faster or more money?
Yeah. So I think the opportunities that we see where this fund will focus is across the early stage technology and healthcare ecosystem in areas such as AI, quantum computing, clean energy, but also life sciences and medtech. And of course, at EQT, we've been investing into those areas out of our early stage technology and life sciences funds for years. And we have a deep pipeline of opportunities. And with this initiative, we're even better set up to support those entrepreneurs and to invest into those startups.
Per, is this about national security? So we don't often think about the fact that you could see U.S. companies, and I don't know whether this is true, but do we need to think about the fact that big U.S. companies could have a switch that actually says, well, now we're only mandated to do the U.S. I mean, is it that critical that Europe builds its ecosystem for tech?
So the way we think about it, as I said earlier, right, the world is not standing still. It's a competitive world. AI technology is advancing rapidly, and we're a global investor at EQT. But we have European roots, and we have the largest part of our organization in Europe. So, of course, we support an agenda that drives, a more business-friendly and a higher growth agenda wherever we invest, and certainly also in Europe, and that's why we're so excited about this initiative.
Are there parts in Europe that they shouldn't focus on, for example, in the tech ecosystem? So if you look at LLM languages, is it too late? Does Europe need to think more about data centers or other parts of the value chain?
So what we're seeing is that when it comes to AI, that there are massive investments being made into AI infrastructure. And so I think that continues to be an opportunity for Europe. But we're also seeing an unprecedented number of native AI startups at the application layer. And I think here Europe also has a real right to win. If I look at some of the investments that we've made recently into companies such as Lovable, the vibe coding platform based out of Sweden, the growth rates that we're seeing here are unprecedented. They've gone from 0 to 400 million euros of annual recurring revenues in record time. So we really see opportunities across the AI ecosystem.
I mean, realistically, does Europe need a Google or an OpenAI? Would it ever have one? So, a company of that size and scale? I'm
not sure we'll be able to produce companies of that size. I mean, we have businesses such as Mistral, of course, when it comes to large language models. But I think what we're focused on is really investing into the opportunity set more broadly across the AI ecosystem. Yeah.
What do you think makes investing in Europe so attractive right now?
I think we have access to world-class talent. We have some of the best universities, academia in the world. And so the talent is there, the startups are there, we just have a scale-up challenge. Yeah.
What are you most excited about? And again, is it different investing in France than investing in Germany than investing in the UK? And how do you bring that together?
We really take a pan-European perspective to this. The pipeline that we have across those target subsectors is really across Europe, from the Nordics to Central Europe to Southern Europe. If I look at some of the subsectors, I think Europe has a right to win in all of those, right? Whether it's in quantum computing, whether it's in space, whether it's in AI or in life sciences.
I mean, and I've always been told that Europe doesn't have to choose between the US and China, but sometimes it feels like we're stuck in the middle a little bit. Do you think European companies, European tech companies, in the next couple of years will have to choose?
I'd say, there are a lot of external factors that we can't control in Europe. What we really need to focus on is just driving a competitive agenda ourselves across Europe to make sure that we drive a more innovation-friendly, a more business-friendly agenda. And this scale-up fund initiative is one of many, I think, promising actions that are being taken right now across Europe.
So the mandate is very fresh because we found out about it only late last night. Yeah. So congratulations. Can you give me a sort of timeline of how much, so it's $5 billion, I guess, in all. How's fundraising going? When can we see the first kind of, cash being deployed?
So as I mentioned earlier, right, a substantial part of that €5 billion fund has already been raised. So I think, and the pipeline is there for us to invest into. So we want to get going as quickly as possible, and I'd say we expect to make the first investment at the very latest during the third quarter.
So, it's fast. I mean, things are moving so fast in quantum computing and AI and tech companies. So is that why you have to move, put the accelerator?
The opportunity is here right now in front of us, and the world is not standing still. So. And we're ready to make those investments. We have the infrastructure, we have the people on the ground, and we have the pipeline across those target subsectors to invest into.
Do you believe it's been harder for a lot of the companies that you've been talking to because of the war in Iran? Has that had a spillover effect, or is it fairly immune because the sector has still seen buoyancy even in Europe?
If you think about these subsectors and the opportunity set that we're looking at, is relatively speaking less impact by sort of what's happening geopolitically in the world and where oil prices are. But of course that does have an impact on overall economic environment and also risk sentiment. So from that perspective, it has an impact. But I think these businesses, these founders are more focused on executing on the opportunity ahead and getting access to that scale-up capital that they need.
So interesting. Per, thank you so much for joining us. That was Per Franzén.
Thanks for having me.
The EQT Chief Executive with us here in London. Now, coming up, we're joined by the Co-Chief Executives of Goldman Sachs International. We'll discuss inflation, we'll discuss market volatility, and of course, the deal-making outlook. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says he called off a strike on Iran planned for today after an appeal by the leaders of Persian Gulf allies who called for more time to pursue a diplomatic solution. The head of the OECD tells Bloomberg the global economy is at risk of further deterioration over the Middle East conflict. We're live in Paris for the meeting of G7 finance chiefs. Plus, Standard Chartered plans to eliminate thousands of support roles over the next 4 years, joining the ranks of global lenders using AI to trim headcount. So if the conversations we've been having so far today have taught us anything, it's really now it is certainly not a boring time to be an executive in finance. That's true. Between navigating market volatility, negotiating cross-border M&A, supporting colleagues and clients in the Middle East, but also finding new talent to hire, every day brings new challenges and new excitement. Well, my next guests know this better than anyone, and I'm pleased to be joined by Anthony Gutman, Co-Chief Executive of Goldman Sachs International and Global Co-Head of Investment Banking at Goldman Sachs, and Kunal Shah, Co-Chief Executive of Goldman Sachs International and Global Co-Head of FIC at Goldman Sachs. So thank you both for joining us. So you've been in this job together as co-CEOs for a little over a year. I mean, everything's been thrown at you. There's there were Middle East war, there was Venezuela, there's a lot of, inflation, central bank. How's it been?
Yeah, well, look, firstly, thanks for having us. Great to be here. There's no question it's been a pretty turbulent environment. In these kind of environments, we see huge opportunity. It's a point in time where our clients need advice and they need support. We're obviously spending a lot of time trying to give them that and helping them navigate this environment, as complex as it is. And, and that's really key to us. As you know, everything in our business is about our client relationships and engaging with them. Look, I'd say the thing that's really critical in Europe, and I'm sure we'll talk about it, is we have to run a global business, but we have to run a local business. We want to be close to our clients. Right now we're operating in 29 offices across 23 cities, and really what Kunal and I have been focused on is making sure we get to all of those offices, see our people, and see our clients. And our clients want us to be there on the ground, close to them and near to them, to give them the advice and the support that they need. I would tell you that beyond investing in those relationships, there's 3 or 4 things that are really key for us, and that's what's been key in the last 12 months. Firstly, regulation. I'm sure we'll talk about that, but we want a pro-growth agenda. You've heard it from the earlier speakers today, and so we're spending a lot of time with European regulators and governments. We're leaning a lot into operational growth, by which I mean productivity gains and everything that can accrue from what we're doing on AI and collaboration within the firm across the divisions. We see enormous opportunity there. And then we're also very invested in our culture. This, Franzén, the culture of the firm is really important to us, and so we're spending a lot of time with our people trying to engage in the collaboration that comes from the divisions working with each other, and so far so good.
Kunal, if you look at global deal making, has there been a slowdown, or do you anticipate one because of the regional war?
Look, as Anthony said, times are uncertain, but even though our clients don't have clarity, I think the good thing here is that hasn't actually held up activity. No. Because although they may not necessarily know how the current war plays out, there are key structural themes they're focused on, whether that's resilience, whether that's diversifying supply chains, whether that is AI and technology. So actually, when you look at deal making at large in the region, there have actually been some real tailwinds there.
Yeah, and we'll talk about regulation in a second. We'll talk about the UK. But actually, when you look at the feedback, I guess, from large sovereign wealth funds in the Middle East, will they continue to remain active amid the conflict?
Yeah, look, we're spending a lot of time in the Middle East. I was actually down there a couple of weeks ago. I think they are trying to operate in a fashion which is as consistent as can be with business as usual. The level of capital deployment, to us seems unchanged. There's no question they're maneuvering to adopt and adapt to a new environment. That's a thoughtful approach to it, and they're navigating it well. We're seeing a lot more focus, obviously, on technology, on AI. We're also seeing an enormous focus on infrastructure spending, both domestically and internationally, and we think that's a thoughtful place to be. We think it's a good opportunity for them and for us. I would just say, we remain highly committed to the region. We have over 100 people there. We have 5 offices. We're trying to do our best in this environment to support our clients and the sovereign wealth funds there. And I'd say, some of the things we've announced in the last few months have been consistent in that. I'm sure you saw this MOU that we signed with the Qatar Investment Authority for $25 billion. That's really about Goldman Sachs Asset Management working in partnership with the Qataris as they seek to invest globally across public and private strategies. We've done the same with PIF in Saudi. We're very excited about that. The other thing I would say, by the way, which is really critical to our business in the region, and we think critical to our clients in the region, is that there is an enormous swathe of ultra-high net worth clients who really will benefit from our services, and we're trying to invest in that.
There does seem to be a difference between some of the private deals, private equity deals, and actually what we're seeing elsewhere. Do you see that difference?
I think on the deal-making environment overall, you're touching on an important point, which is if you step back and look at what's been going on in the investment banking business, we had a first quarter with just shy of $1.5 billion of advisory revenues. That's up about 90% year on year. We've seen M&A volumes up about 35-40% versus 5-year averages. But that activity is largely coming from big corporate M&A.
Right.
Deals in a size range of $5+ billion are up significantly. And that's really generally been about corporates trying to drive industrial leadership. What we're seeing in the market right now is that there is a real premium attached to being a market leader, having the scale and liquidity that comes from that. And the markets are rewarding you for doing those kind of deals. It's definitely been more muted on the private equity front, although we think that you'll see more activity there. Yeah, we think so.
Second half or sooner?
Look, in part, it's going to be driven by what happens in the IPO market.
Yeah.
You know, the IPO market really is looking pretty healthy, particularly in the US, but we think there are signs of it building here in Europe. That's an important liquidity mechanism, as you know, for private equity. But I think they're also going to be leaning more and more into M&A activity. I mean, we all know well that there's a lot of pent-up inventory sitting in private equity hands,
Yeah.
And, I think that there's a degree of pragmatism both on the buy side and the sell side around, finding appropriate asset pricing to get these deals done.
Kunal, the UK. I mean, there's a lot going on in the UK.
There is.
None of it is really that good. How are you expecting, first of all, client behavior to change given the political uncertainty?
Now, when you say it wasn't that good, actually Q1 growth was better than expected. So there were actually some tailwinds going into this. Of course, the war has had its effect, and whether it's the UK or Europe, just given the energy import requirements, of course, that's going to have a hit on growth. You're seeing this stagflationary impact on inflation. It's meant the Bank of England, as you know, went from expected rate cuts to now largely market pricing a couple of hikes. So that has led to pressures. I'd say it's also at a time when sovereign bond markets on a global scale have been facing pressures. You see this with treasuries, Japanese bonds, bunds, and the UK. And then, of course, you combine that now with the political uncertainty that's there. Look, we're not in the business of making political predictions. What I can tell you from our client base, when they look at the UK, it's a market which has actually served them very well. It's a great base to have for business and to be able to really transact and deal globally. But what our clients really need is certainty. And when it comes to the policy framework, which of course gets discussed as we think through what the next leadership may look like, what they really want is clarity, predictability, and something which hopefully is sustainable. So our clients can then go back to actually focusing on their businesses or their portfolios, which I think is really what's needed, because ultimately what this country needs is growth.
I mean, this is the one thing. Everybody wants stability. The UK Treasury recently announced new plans on ring fencing expected, in a couple of weeks. Does that make you rethink anything in terms of Goldman Sachs plans? Any impact, for example, for Marcus?
Yes, so look, when you look at the ring fencing regime, as you'll be aware, it's a particular quirk of the UK.
Yep.
We think it's constructive that they're now following up this consultation, which for the ring-fence banks should lead to some reduction of friction and costs. We're not a ring-fence bank ourselves. We have capacity up to a headroom limit of £35 billion right now. So we have been, of course, growing our Marcus deposit product in the UK. Now, I think what's been especially productive in the recent announcements is the fact that that limit's now going to be reviewed on a 3-year basis, which is important. When you think about a global bank like ourselves, we've now got more clarity on the end zone for regulation, whether that's the implementation of Basel III, but also in the US, we now have clarity on the supplemental leverage ratio and various other rules, which means that we can now really project forward for growth and how we can really scale our business with our clients. And it's important that the UK remains within that. So now having more clarity that our ability to raise deposits and fund our business in the UK will have periodic review, of course, helps.
I want to talk about regulation in a second, but West Streeting has also put a Brexit reversal on the table. He's trying to challenge the Prime Minister Keir Starmer. At this point, do you think the City of London would even want to rejoin the EU?
I think when you talk about Brexit reversals, of course, having a more open trade relationship with Europe would help. And there have already been discussions and some hints towards that direction already. There are clear lines to cooperate when it comes to defence. So I think that too is constructive. As for financial services, we can see what I can tell you is London still remains a vibrant centre. To Anthony's point, we've absolutely extended and expanded in the continent over recent years. For us, that's been very productive because it's really just meant that we've got closer to our clients in Europe.
Talk to me about regulation in Europe. I mean, it's kind of, there's a sweet spot, and it feels like we're not there yet in Europe, that maybe there's too much regulation.
Yeah.
Are regulators, understanding what's at stake?
Yeah, by the way, I think you're right. There is a sweet spot. Look, Europe continues to have huge opportunity. We feel very strongly about that. And we actually are optimistic about Europe. It represents 9 to 10% of the global population. It's 10, 15% of global GDP. But it requires Europe to operate in that capacity as Europe, not as 27 separate member states. And so what are we focused on? We're focused on that goal, and it's a simple goal. We really want Europe to operate in a cohesive fashion. What you just heard from your prior speaker around this technology fund, that's an enormous opportunity. I think they are leaning into 2 simple goals, which is consistent with our philosophy. Number one, we need to make it easier for business to operate pan-Europe. We can't have local jurisdiction, local regulations, and local
You really believe
admin.
it? 'Cause we've been talking about it for a while.
Yeah, we do believe it. We do believe it. Look, we think it's going to take some time.
Yep.
We think you have to be patient. You think you have to be persistent. But I think European leaders and regulators get the need to make Europe an easier place for people to operate cross-border. And they also get the importance of having a deep, unified capital market so that actually when those corporates, when those startups scale up to a sensible place, they can access, a proper capital market that has the depth and liquidity of both the US and Asia.
Look, there's just a lot going on in markets, and it's AI. It could be the AI trade. How do you see the risks over the next 6 months in markets? It doesn't feel like the Middle East is getting any better, but I guess businesses have also a way to adapt and adjust.
Yes, so global stock indices, of course, have really been strong. Many of them at now all-time highs. As you point out, AI has been a dominant theme. There is very narrow breadth when you really look at that outperformance. The US has really led this retracement post this conflict starting, but it is quite concentrated. And you're now starting to see some wobbles since Friday where the momentum trades are starting to turn, but it has really been a big structural trend. The market is, of course, looking at earnings coming out like Nvidia, et cetera, to really path forward. I'd say what we see from our own business and our own clients is real commitment to continue to scale. Now, some of that is just down to the insatiable demand for compute and really this race for capacity. But I'd also say from a corporate level, people are really starting to see the benefits from a productivity lens of this technology. So we do think that structural trend is there to continue. Of course, there'll be bumps along the road. We can have a debate on AI on whether the value is going to accrue at the chip layer, the infrastructure layer, the model layer, the enterprise layer, and a lot of that is going to remain to be seen over the cycle, but it's clearly a place that our clients are focused. Now, of course, one of the disconnects we get, though, is the fact that stock indices are the high, but the price action in bond markets is obviously problematic on a global basis. Thus far, most of the sell-off we're seeing in bond markets is because of the inflationary impact of the current conflict. But there's a vicious cycle where the raising interest rates starts becoming a fiscal problem, and that's when things can sour and turn. I'd also say that right now the market's focused on inflation and those impacts from the war, less the growth impacts. Now, that can bite too. We've survived thus far to May because inventories and commodities were higher. There's been some substitution, but at some point those stockpiles can run dry. So if we don't get resolution on opening up of the strait, of course, that can start to have a real supply side impact. And that's when the confluence of these things can become more problematic for markets.
Yeah, and that's it's something for the second half of the year, right?
Absolutely.
That's when it can become problematic. Thank you both for joining us. That was a great conversation. Anthony Gutman and Kunal Shah, co-chief executives of Goldman Sachs International. Now, coming up, oil prices decline as President Trump offers Iran a reprieve. We'll have plenty more on that next. We'll also go to Paris for the G7 finance chiefs. This is Bloomberg. Bill Winters, the chief executive of Standard Chartered, says artificial intelligence will eliminate thousands of jobs at the bank as it replaces what he called lower value human capital. Now, the lender plans to cut more than 15% of support staff by 2030 as it expands its use of AI to streamline operations. Now, Standard Chartered employed about 52,000 people in those roles at the end of last year.
It's not about cost cutting. Although that will be the result for sure. It's about having a structurally more productive environment that is fit for future, given the financial markets and the financial infrastructure world that we're going into.
Jensen Huang, the Nvidia chief executive, says semiconductor demand in China is incredible. And he expects authorities there to eventually allow the import of AI chips from the U.S. Now, Huang was a last-minute addition to a delegation of business leaders who traveled to Beijing for President Trump's summit with Xi Jinping. Now, he spoke to us exclusively in Las Vegas alongside the Dell chief executive.
The president wants America to win everywhere.
Right.
The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and to explain very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jensen, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200.
Right.
I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Jensen Huang, the Nvidia chief executive, and Michael Dell, the Dell chief executive, speaking exclusively to Bloomberg's Ed Ludlow. Now, President Trump says he's called off strikes on Iran scheduled for later today. That's after the Gulf allies asked for more time to seek a diplomatic resolution.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Well, joining us now is Jumana Barsechi, Bloomberg's Horizons Middle East and Africa anchor. Jumana, thank you so much for being here. I mean, the President Trump's Iran threats are a little bit discombobulating because we thought they were looking for a diplomatic solution, then there were threats, but then he backed down.
Yep, escalate, de-escalate, escalate, de-escalate. We've been here many times. But I think if we rewind back 24 hours, remember, President Trump also threatened that the clock was ticking for Iran to come to the negotiating table to make a deal or else. And now we know, in his own words, if we take it at face value, they actually did come very close to launching a second wave of attacks, if we believe what he said. And indeed, there was lots of media reporting yesterday suggesting that he had been briefed on various military options, but at the request of Gulf allies, and he specifically cited Saudi Arabia, Qatar, the UAE, he's decided to hold back, at least for a couple of days, with the view that maybe Iran this time around will come to the negotiating table. Now, at the same time, Franzén, we are back where we were discussing the same issues that we've been discussing for the last couple of weeks. The fact that they have a different timeline vis-a-vis how they're going to reopen the strait. The Iranians are asking for the blockade to be lifted. The U.S. are saying that they're not going to do it until the Iranians lift their own blockade of the strait. The nuclear file, obviously very complicated, and the Iranians are saying that they have a right to continue with nuclear enrichment. But in order to get to that level of discussion, you have to pass through the other items sequentially. And of course, of top of mind for the U.S. administration right now is what they're going to do with the Strait of Hormuz.
Of course. And I mean, the U.S. also issuing a new Russian oil waiver to free up supplies. That feels significant.
It does feel significant, and also just a reflection of how much pressure energy markets are under. The U.S. administration is doing what they can to cap the move upwards in energy prices. We have Brent once again sitting at $110. There were some, again, media reports coming through from Iran yesterday suggesting that the U.S. might actually introduce a waiver or reintroduce a waiver on Iranian oil exports. That was not the case, but they did extend the waiver on the the Russian one that expired a couple of days ago, for Russian oil that's already on water. But the point is here, they are under a lot of pressure. The price of gasoline per gallon keeps the tick up. In the U.S., we're heading into midterms. The war is increasingly unpopular, and this is one way, perhaps, to cap the upside that many energy analysts are expecting to come throughout the month of June.
Jumana, thank you so much. Terrific briefing there from Jumana Bersachi, of course, on what's happening in the Middle East. Now, G7 finance chiefs are also meeting in Paris today with an inflation shock looking likely to endure. They must come to terms with the new economic reality. The OECD Secretary General, Matthias Cormann, spoke to Oliver Crook on the sidelines of the event.
Normally, you would be able to see through an energy price shock, but of course, if it starts contaminating prices more broadly, if you see increases in wages as secondary effects, then central banks will need to take action, even if the economic growth outlook is somewhat weaker. Across advanced economies, what we see is that core inflation remains, relatively okay. Yeah. But of course, that's precisely what we will be looking at.
Well, let's bring in Bloomberg Chief Europe Correspondent Oliver Crook. Ollie, good morning. So what more have we heard about the impact of the Iran war?
Yeah, so it's very interesting because obviously for central bankers and finance ministers here, everybody's focused on A, inflation, and B, the impact on growth. And of course, that stagflationary dynamic we've been talking about as a consequence of this war, particularly here in Europe. It seems so far from the conversations I've had and what we've heard from a number of finance ministers, and we'll be quizzing the chief of the Bundesbank and the Banque de France a little later on this, is that for the time being, obviously inflation is rising, but it's staying more or less segregated to the headline level. They're not seeing very explicitly the secondary effect, but you heard it there from Matthias Cormann, the OECD Secretary General, that this is a risk, and that even if you do get that inflation spreading from energy to the headline to other parts of the economy, you may still need to sort of hike rates in the face of diminishing growth. And that is the very difficult conversation and scenario for many of these politicians and policymakers here in France meeting. And of course, speaking to Scott Bessent in the search for sort of what the U.S. policy is going to be going forward, particularly since we get some conflicting reports. On the one hand, Bessent wants to see more sanction enforcement on Iran. On the other, potentially they're putting out this idea that they may waive some of the sanctions on oil in order to keep the prices diminished. So those are some of the conversations that are happening here just behind us.
And Ollie, EU officials will meet to finalize a trade deal with the U.S. to avoid more tariffs.
Yeah, that's right. I mean, this is the other conversation that is being more centered around Brussels, trying to avoid that increase in tariffs from the Trump administration. You'll remember President Trump has set the deadline of July the 4th, the 250th birthday of the United States, for the EU to get this deal agreed to, ratified, and put into power. There's going to be a meeting a little bit later today to try to make a sort of meaningful step to get towards that deadline. The real question is, given how slow the EU move, can they hit that deadline? That's going to be absolutely crucial, because the last thing you want, Francine, in addition to a stagflationary shock, is another trade war.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, from the G7 finance chiefs meeting in Paris. Now we'll have an exclusive interview with the Banque de France governor and the president of the Bundesbank. Ollie Crook will be conducting that. It's at 1:30 p.m. London time. Don't miss it. It's probably one of the last ones by Monsieur François Villeroy de Galhau before he steps down. Now the picture for markets is one of, it's very tentative, actually. If you look at tech stocks, they're slipping. Traders really trying to find out what will happen in the Strait of Hormuz. Money managers increasing their exposure to stocks by the most on record last month. That's according to a survey by Bank of America. Up next, Bloomberg Brief. This is Bloomberg.